This is a Momentum Media production.
Have you thought about growing your wealth but don't know how to start? Talk to Invest by Metricon. They make property investing easy. So for all your tomorrows, build your financial future today. Invest by Metricon. Build wealth. Build today.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Certainly is the podcast by investors for investors. Phil Tarrant here, executive editor, real estate and Momentum Media, host of the Smart Property Investment Show. Welcome. Hope you're well. Don't want to get into the nitty gritty of the COVID-19 discussion, but we now have some pretty clear undertakings from the state premiers under the auspices of the federal government to get the nation opened up here in New South Wales. 70% vaccination rate, 80% vaccination rate. Looks like things should be back to pretty normal by the 1st of December. I think the same thing applies in a whole bunch of other states. Melbourne has given us their roadmap for emerging out of COVID-19. The great restart when real estate gets back into normality. But what happens to the economy, who knows? We'll be watching it pretty closely on smartpropertyinvestment.com.au. You're probably all across a lot of the information coming out recently, last day or so, around mortgage stress, something I want to keep an eye on, which sort of really triggered through the IMF, who is starting to get a bit jittery about the level of debts in Australia, the low interest rates, and potentially people overextending themselves when it comes to investing in property, whether they're investors or owner occupiers. What may happen, and I think it will happen at some point in time, there'll be some sort of government intervention, whether it's going to be increased in the cash rate, who knows, or whether APRA might get involved in trying to slow down investment lending. Watch this space, but we're going to get into it on smartpropertyinvestment.com.au. But as we gear up for the Christmas season, the silly season, a lot of time for people to reflect and recharge and think about the future. And one of those areas where I'm seeing a lot of attention now is those investors who are highly connected in with investing in property, but doing it in a slightly different way. And we're very fortunate over the last decade or so, there's been some emerging tech to support different ways to think about investing in property. Most of us, if we have a super fund, whether it's a retail industry fund, we probably have some exposure to property anyway in the shares that we hold. Those just with SMSFs, we may have direct property in there, but there's other ways you can hold property. Sort of a bit of a theme I wanted to get in today. You might have seen on smartpropertyinvestment.com.au over the last week, we ran a bit of a straw poll trying to get some insights into fractional investing, just whether or not our audience, of which there is many, many tens of thousands of you that are connecting with Smart Property Investment every single month, knew about fractional investing and get some sense for it as well. And the numbers were pretty interesting. So well over 300 responses to this, which makes it a significant sample size. So we could actually draw some interpretation analysis from it. Over 52% of all people who filled in the poll are keen on knowing more about fractional property investing, which quite surprised me that it was that high, because it is a bit of an alternative way to invest. The other interesting stat was 49% would use their SMSF for fractional investing. So got me thinking, pretty important stats, trying to sort of pull this out. It's like, pulling a thread. The more you get into it, the more it unravels and the more questions you have. So I've asked Warren Gibson to come into the studio to join me. He's one of the executives over at Domicon. I've known Warren for, it's got to be a decade, at least, across a lot of the wealth stuff and a lot of the work that he's doing within fractional investing. Warren, how you going? You well?
I'm good, thanks, Philip. Thanks very much for the invitation.
Yeah, no, mate. It's good to have you on here. I'm going to be leaning on you to give me some interpretation of what all these numbers mean. But probably at the front end of it, I know what fractional property investing is. And I think by memory, I've even hosted a couple of, panel discussions at property shows back when people used to do property shows. They're long gone now. Everyone listens to the podcast now. This is a new way of getting your information. So I've got a pretty good understanding of fractional investing, but I'm not going to assume that our audience have that same level of knowledge around it. So let's just start there, mate. What is it? What is fractional investing? And I guess that's what Domicon does, right? Provides the mechanism to make this happen.
Well, what Domicon set out to do was to bring technology into the property asset class and to make it to democratize property, if you like, to make it easier for people to invest smaller amounts of money into direct property of their choice. And choice is a very key word in this discussion. So, we brought some of the equity market concepts to property. In equities, you invest, via a broker, the ASX, and you buy shares in a variety of different companies to create a diversified portfolio. In property, you buy a property or you don't buy a property. It's an all or nothing proposition more than anything else. So if we can fractionalize that, in other words, break down these assets into, or unitize it, break them down, and you can buy a little bit of this property, a little bit of that property, you can develop a diversified portfolio across a variety of different property types and a variety of different geographical locations. So you're diversifying, and diversification is, one of the greatest risk minimization strategies there is. So it's not a new concept, and there are different terms for that have been used for this, from crowdfunding and fractional investing, syndication, but it's all pretty much amounts to the same thing. It's a group of like-minded people who come together, or they're brought together by an advisor, or they come together themselves, and they can be family and friends that do this, and they acquire a property. And we put the property on the platform, we fractionalize it or unitize it, and they get units in proportion to the amount of money that they invest, and therefore share in the income that's produced and the future capital appreciation.
So yeah, that makes sense. And I guess the point is, Warren, is that this is not a new concept at all. Most people are fractional property investors. Even if you invest along with a husband or a wife, you own part of that property. There's been business syndicates for years, or friends clubbing together, hundreds of years, that buy property in lockstep together. What it sounds like, you've just put the rigor, the process, the systems are on steroids, largely what used to be happening, into something which makes it a lot simpler and easier and tradable.
You effectively need a technology platform to do this, but you also need a legal structure. It's interesting, you should say that when we first started talking about this a number of years ago, and I remember saying to my wife about this fractional investing, and she said, I don't know that I like the idea of having a co-investor, in a property. And I said, we have one now. And she said to me, well, what have you done? And I said, I haven't done anything. I said, but we have a co-investor. It's called the bank. And I said, so what difference would it make if it's the bank, or it's, Betty and Bob down the street, or Joe Blow's self-managed super fund? You won't know who they are. What difference does it make? Whose money makes up the acquisition? We've put in a deposit. We borrowed money from a bank. What happens if we put in an amount of money and a bunch of other investors put in an amount of money, and we get to be the tenants there, but we're also part owners? So that's basically where we started. I
remember a lot of our earlier conversations, Warren, was around a lot of the sort of regulatory headwinds that you guys were facing, because you were trying to actually systemize something that's always happened, but in a way in which made it a modern approach to it all. Are largely those headwinds sort of beyond you? They're sort of tailwinds now, and you guys are rocketing along?
Yeah, we've fought some good fights, and we have a legal structure now. It's called a managed investment scheme. There's thousands around, as you know. It's not a new structure, legal structure. It's been around, but we needed to have a few bells and whistles and a few to make it work in the way in which we wanted it to work. And we have a trustee who oversees all of the transactions. We have a custodian who holds the title to the properties. So it's not just us on our own. There are other parties involved. We have a due diligence process. It's independent of the management. We're just the manager. People who do a legal review of the contract of sale, property inspectors, independent valuers, pest inspectors, and we have this process. And all properties must go through that process, and if they don't pass muster, then we don't proceed with it. And we have knocked a few sub funds back for structural issues or land issues or whatever, or valuation issues. So we have a process. We've systemized a process, and it works really, really well. Now, the other part of all of this is, well, the thing about property is liquidity. People are concerned about how liquid is this. Property is not a liquid investment. Well, we wanted people to be able to get in and get out of property. So we put a time frame around the length of the term to expiry of the sub fund. And so for residential property, we might make that 5 years because we think that's a reasonable period of time. At the end of 5 years, we'll wind up the sub fund, sell the property, and everybody takes their money and goes home. Now, those who want to keep the property, then we'll put it to a vote. And provided they buy out the ones that want to get out, or we bring new investors in, then we can roll it over and keep it going. But those that want to leave, get to leave. Then we sought relief to operate a secondary market. We call it a liquidity facility, but by and large, it's a secondary market. It has market depth screens. It has buy-sell screens, very much like an equities trading platform, where people can come in and they can offer to buy units or sell units in different sub-funds for properties. And so that gives them another liquidity option. The third liquidity option is if somebody thinks that a property is not worth keeping and they want to dispose of it, they can come to the manager and we'll put it to a vote to their fellow investors. And if there's a 75% agreement, we will wind up the sub-fund, sell the property.
So there is that liquidity there for people to be able to, like equities, they could trade in and out.
Very much so. Where the financial advisors are concerned, if they're coming in through a financial advisor, they often provide that liquidity because they will find the new investors to come in.
So that's a good point. How do people sort of get involved in something like, or an organisation like Domicon? Is it through their financial planner or advisor, or is it sort of, can you go direct as well? Because I guess we're having a chat directly to investors today.
Absolutely. No, they can come in. All they need to do is, and it's an online process. They complete an application to become a member. They need to deposit some investment funds, but they don't have to deposit everything. Just $1,000 will see them through the 14-day cooling off period. They can add further funds after that. And then they can scroll down and have a look at all of the properties that we have. They can look at all the properties for sale in Australia. We have a hookup with domain.com, and they can look at any property for sale on Domain. They can see it on our platform. We get a direct feed through from Domain. So if they're looking to purchase a property, they can look through and say, well, this is a nice property, or they might find one that's off market, and they can bring that to us and we'll create a campaign for them. And there's two ways of doing that. We can create a public campaign where anybody can see it and join, or they can create a private campaign and invite people to participate. So it might be family and friends. They might invite them via an email or a Facebook or a Twitter facility.
So that's interesting. So on your site, you say this property here is people are interested in this. Do you want to join this particular, to club up to buy this particular property? Or the alternative is, hey, I found this place. Does anyone else want to contribute to this particular deal?
We have property developers, and we have property sponsors who might put up, come to us with a property. We don't source the investors for them, but if they've got investors and they've got a project or a property, it might be a renewable energy plant, solar farm. It could be an agricultural property. If they've got investors, they can bring that property to us, and then they can invite those investors to participate, and we do the fractionalisation for them.
Okay. I'm quite keen on this stat around how many people were interested in fractional investors, which I thought to be some, but there is a lot. Let's get into that. We'll just go to a break beforehand. Stay with us. Back in a moment.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? we can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, and with Warren Gibson from Domicon. Warren, were you surprised by that more than half of all property investors are interested in fractional investing? Is that sort of aligned with the numbers that you've been using as an organisation over these years?
Well, I've always thought that there would be a depth there. I'm excited by it. I guess I'm a little surprised at the numbers, but it's early days, and I'd still like to see that progress a little bit further. But there are a lot of people out there, and there's a lot of talk about the difficulty in getting into the property market, particularly for young people. And the alternatives are that we go down the path of some major cities overseas where people just never own a property; they just lease for
life.
And I think there's some concern that is that going to happen here, where our children or our grandchildren aren't going to be able to afford a property and they're going to be tenants for the rest of their lives? No. It can be part way. It can be half and half, or you don't have to. You can still be in the property market even though you don't have the whole property. So why can't it be a little bit of both? And we have that structure that enables that to happen, and we have a structure that enables families to help their kids with that by being co-investors in a property. So there's a lot of interest out there for that. I think there's also growing interest in renewable energy. There's growing interest in sustainable farming, and that really excites me. But we can talk about that in a little bit more.
Yeah. I want to actually have a look at the different asset classes. But before sort of structurally, we go there. What is the minimum number of people that can or should participate in fractional investing, and what is the sort of maximum per your remit, or what do you have flexibility around?
There's no minimum, no maximum. Probably the biggest sub-fund we have is a cattle property in the Western District of Victoria. There are 94 unit holders there. And the smallest may only be sort of, 6, 7, 8, 9, 10 people. So there's no minimum, no maximum. The minimum investment's only $1,000. There's no maximum.
Mm. And is there any debt connected with the asset purchase, or it's all cash?
That's a really good question, and that's another battle that we've had over time. The Domicon fund is the non-recourse fund, which makes it very, very difficult to get debt from banks. But we do have through La Trobe Financial Group. They are our default debt provider, and they will lend. Our fund must also remain positively geared, so the maximum amount that we can probably do is 50 up to 60% for residential property. So yes, we can put debt into it, and we are on the lookout for other debt providers.
Okay, well, I imagine with the sort of numbers that we're seeing here and this interest in fractional investing, where there's investors, you normally find lenders, Warren. We all know that because lenders are in the business of making money by lending money to people. So anyway, we won't go into that today.
Interestingly, I must digress yet again. We are shortly to launch an equity mortgage fund.
Okay. Where
we put money into a loan sub fund, and that money is then lent to an equity sub fund for a handsome return and first mortgage security over the property. So people can actually, if they're looking for income, put money into that. If they're looking for capital growth, they put it into the equity fund. And advisors can create equity and mortgage sub-funds themselves and control both sides of the transaction. So
there seems, and maybe this is an emerging thing, through education and awareness, no doubt, as part of it, but a lot more investors interested in having a look at fractional investing versus the amount of people that actually use it now up until this point. So why do you think it's been not as fast in the pickup in terms of these opportunities to invest in a unitized level in property. Australians love property. Normally they grab at anything. They think they make a dough out of it. Do you reckon it's just an awareness and education issue?
I think it is. Also, it's turning the industry on its head. I talk to a lot of real estate agents and they don't necessarily get it. I think they're a little bit concerned that it might be putting them out of business. Our response to that is that no, it's actually opening up the market to you. There are a lot more people who will buy into real estate who can't afford to buy a whole place on their own. So, it's just a new model, Philip, and people are a little bit skittish about new things. Financial services industry, yes, you can understand that. There's been a few things that have, not gone well in the past, as you know. So that may make them a little bit nervous. But slowly they'll come to the realisation that this is no more different than investing in a diversified equities portfolio.
And what's the sort of client base look like now, Warren? Is it largely younger Australians looking to get exposure to property but can't buy the property themselves, or more sophisticated investors who are looking for a wider diversification, or is it both? Is there sort of percentage either way?
Large percentage of self-managed super funds, so they would be of an older age group because they've acquired some assets in their self-managed super fund. But again, on the younger investor side, they're coming through. I'm hearing more about particularly around agriculture and renewable energy. They're interested in things like that. So it's spreading to a younger audience as well.
Yeah, there seems to be this growing trend around ethical investing with the younger crowd who they're just as much as concerned about the purpose of the investment rather than making money out of it. So, and we're seeing this as a trend right throughout the wealth sectors, both in Australia and globally. We'll get another break. When we come back, I want to get into these asset classes, get a greater understanding about how it works. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant from Smart Property Investment with Warren Gibson from Domicon. Now, Warren, you gave me a couple of examples before about the types of things that can be fractionized. Is that the right use of the term, fractionized or unitized? You mentioned a cattle station with 90-odd sort of sub-investors as part of it. Like, how big is this cattle station? Like, I'm quite a visual guy. How many acres is it? What does it look like? It's got cows on it, obviously. And they owned it properly and not the business, I would imagine. How does all this work?
Yeah, the property is about 500 acres, so it's not huge. It's just purely cattle. There's no house on this particular parcel of land. And a grazier whose property is across the road, he wanted more land and couldn't afford to buy it, but he put a little bit of money in, and he's one of the unit holders as well, and he leases the land from the sub fund and runs his cattle on it because he wants to build his herd. So that's what we did with that, and it worked out really, really well. The genesis of this was probably some years back when you may recall the Kidman.
I was going to ask about that. I'm going, these guys tried to, maybe it was a bit more of a publicity stunt, trying to buy the biggest property to protect it from overseas investors by memory, wasn't it? Well,
it was a giant publicity stunt that actually got a lot further than most people realise. At the end of the day, we ended up with 5,000 people who pledged $80 million to purchase it. We then got a major bank agreed to put some debt into it, which took it to 150 million. A syndicate of investors to buy the cattle, And bearing in mind, it's like, I think at the time it was 185,000 head of cattle there. So at $1,000 a head, there's 185 million.
By memory, this block of land was bigger than France or something or other, wasn't it?
24 million acres. There's 17 individual properties made up the Kidman holding, something like 2% of the entire Australian landmass. Under lease from the government, and so that's what they were selling, was the lease, and the Chinese were looking to buy the entire thing, and it got stopped by the Foreign Investment Review Board, and but anyway, so we had so if we add up 80 and 70 and 160, I think it was, in the end we were only we were very, very close. We're only $60 or $70 million off. Off the face. And in the end, I think Gina Reinhardt bought 2/3 of it, and the Chinese actually ended up getting a third in a partnership with her, and that was approved by the government. But it was a very emotional period, and people didn't want to see such vast tracts of Australia sold off to foreign interests and so on and so forth. So, but it showed us that people were, I think, interested in that particular thing.
So that's sort of at a big scale. I doubt you're working on many more of those sort of deals, but at a more localized and approachable sort of area for most people, resi property. So like houses, units, one person, 10 person.
Look, there's been some student accommodation, and that looked good at the time, with sort of 8 to 9% return, rental returns, no real capital growth to speak of, but education, was our fourth or fifth largest sport industry, hundreds of thousands of students. Here, COVID, of course, put a halt to that, and there's loads of them now just sitting vacant. But people believed in that. We as a fund manager are agnostic. We leave choice, and we come back to that word, to everybody else to choose, as long as it passes the due diligence, evaluation, and so on, and inspections. That's fine. Look, strata car parks, again, not hugely successful. Residential property, house and land banking, apartments. There's a whole raft of different types of property. Again, if you go out in the street and ask 100 people, you get 100 different opinions about the property market. So,
but there must be at Domicon, you must largely have a lot of faith in property as an asset class, irrespective of its resi, commercial, agri. Even talking about renewable farms and stuff, like it is still the heartbeat of the nation, property, and therefore I think long term it's as an asset class. You need to see what's gone on the last 2 years here in terms of price growth since COVID hit. Your sort of overall sentiments towards the asset class, you'll just approach them based on the numbers, on merit of the asset, rather than get too emotionally involved in how it looks and feels.
Well, unlike your good self, I've been on the planet for a long time. And that was a compliment.
I know, I got that, mate. Yeah. And, I was just sitting there thinking how long I've known you, mate. Like, God.
I'm thinking the first block of land that I bought was like $4,000, and the first house I bought was, $30,000 and so on. And I think about a house that I bought back in 1993, and I sold it. I sold it for a huge amount of money, and I sort of looked at my wife and I said, "Why didn't we buy 6 of these?" And she just said, "Well, don't you remember we struggled to buy this one?" And I went, "Oh yeah, that's right. We did." But don't you wish? And you don't really want to go there and think about all the opportunities that you didn't follow up on. Doesn't bear thinking about sometimes. So yeah, of course, property's going to keep going. It's a limited, it's in limited supply.
And your view and sort of, it's a tough market because there is no universal national legislation when it comes to property. I remember chatting with the head of the Real Estate Institute of Australia, and on her wall, she's got the original mantra that said, 100 years ago, the goal was universal legislation for property in Australia. Anyway, it's still state-based fiefdoms, but a lot of the rules and regulations around the governance of financial instruments and assets is federally orientated. So how do you guys sort of navigate that particular framework, considering that the rules for property differs from state to state, but the rules for governance of financial instruments is universal.
Yeah, well, we have a property manager who takes sort of care of all of the various differences between the states and the the stamp duties and the rules and bits and pieces. So, we get around that okay.
And how do you guys sort of measure the growth of Domicon? Is it sort of investors who use the platform, or properties under management, or properties on platform? POP, I think is probably the right thing. Are you Proptic or fintech? Or both tech?
I probably a little bit of both.
Yeah,
probably both. I mean, we are unique, and whilst that's great, can also be a bit of an issue. I mean, if it's so great, why isn't everybody doing it, type of thing? But just wait. When wrap platforms and master funds and things started decades ago, they were in a sort of similar situation, and once people see, organisations see something successful, they jump in, and the big institutions, can throw hundreds of millions of dollars at technology, and jump in and follow the lead of somebody else who's small and struggled to really build it.
Yeah, well, I think the investing attitude and aptitude over the last decade has evolved considerably, particularly with, you need to see how people's relationship with financial services has changed from sort of traditional banking relationships and having to go and sit in front of a bank manager and say, oh, please, sir, or madam, can I have a mortgage? Through to the fact where now you've got 60+% of all mortgages originated through a mortgage broker, how people sort of engage and leverage debt through your afterpays and buy now, pay later. And financial services is emerging rapidly, and it's giving a lot more choice to Australian investors, which I think is a real boon. So, being able to sort of diversify or get into property earlier, point number one, but diversify your property assets. What you're doing at Domicon makes a lot of sense, and no doubt that will grow over time. You must see it accelerating just by the day, Warren.
Well, it is, and I guess it's something that we have to kind of rein in our enthusiasm a little bit. I mean, we get people contacting us from all over the world about our model, but we want to get this model right in Australia. And property is not just the only asset. You could fractionalize all sorts of things. You can fractionalize gold. You can fractionalize corporate bonds. We have established Australia's first financial product in seniors home equity release. Equity release is enormous in the US, and it's very, very large in the UK and in Europe and many, many other countries. And but in Australia, we traditionally had reverse mortgages, which are credit products, by the way, not financial products. And I think when we first looked at doing this a number of years ago, there were, I think from memory, 21 reverse mortgage providers in Australia. And I think now there's only about 4. Because what happened when the tide went out with the GFC, that's when everyone gets caught without their togs on, and the global money market dried up quite considerably, and funds simply weren't available, and so a lot of them just closed their doors to new contracts. But we have the government pension loan scheme is a reverse mortgage. Then we have credit products and reverse mortgages, 3 or 4 of those, and then we have a real estate product, and then we have our senior home equity agreement, or equity release agreement, which is a financial product and can be used by financial advisors. So, that's another market for us. We're looking at this equity mortgage I mentioned earlier in a partnership with Crescent Finance, for example. This will help another cohort of Australians who, because of their faith, are unable to borrow money and pay interest. And I'm talking about the Muslim community in Australia, which numbers close to 800,000. And if you look at their home ownership, it's less than half of home ownership for other Australians. And yet here is a cohort that are largely well-educated, have good job opportunities and good jobs, but because of their faith, they can't borrow money and pay interest. So how do they get into home ownership, they have to save it up. And there is a solution around that using the fractional model that we're working on. And we hope to be launching that with Crescent Finance in the coming months.
Okay. Crescent Finance being the Crescent, which is synonymous with a lot of the Muslim faith in the Middle East and elsewhere in the world. So no, that's really interesting. I did actually a lot of Middle East politics at university, Warren. I learned sort of quite a lot around a part of it was the fundamentals of interest payments inside the Muslim faith. It's intriguing stuff. But good to see that innovation is still taking place. And I think we're very fortunate in Australia.
Present Finance also run a superannuation fund. I think there's about 10,000 members of the community.
Okay. This innovation has always been a real driver of financial services in Australia. And you think back to mortgages in the really early days when you had your Aussies and the Wizards come out, which just pretty much go a much better, they're still making plenty of bucks, but they go a much better solution for Australian borrowers. We've spoken a lot about the sort of positives with this, Warren. I get that point. Like all financial investments, you need to go in doing your due diligence and research around it. Where would this product not be right, or this particular investment option not be right for certain people, or where would there be any risks associated with it to sort of give both sides of the coin?
Well, I think you've got to accept that the property is a longer term proposition. It's whilst it's tradable in our model. It's not like the ASX. It doesn't. It property gets valued, once every 12 months, and we don't value it every day. We can't do that. So, patience is certainly a requirement, and it shouldn't be all of a portfolio. Nothing should be all of somebody's portfolio, but it does have a part to play. And if you believe in asset allocation and you say, well, and you examine your risk profile, your appetite for taking risk, and you apply then an asset allocation across the various asset classes, you'll find that most people should have some money in the property sector, but probably not 100%. Some do. Some have 100% in equities. Some have 100% in just one company. But for the most part, it's about diversification. We come back to that again, and spreading the risk. So I think it's got a part to play. And then as to which type of property, well, it depends on whether you're looking for income or whether you're looking for capital growth. Right now, one of the strong sectors is NDIS, National Disability Insurance Scheme property, where the returns can be as high as 10 to 15%. And there's a huge demand and a massive waiting list of disabled Australians looking for a purpose-built home. And so, that's coming along, and there's a lot of government financial support for that, and that's why the returns are much better. So, that's another sector that we are actively involved in. And in the agri, we're looking at 5% rental returns on farmland plus capital growth. Our property in Western Victoria, which might be a little bit exceptional, has gone up 43% in 4 years.
Can't complain about that, but it's not accepted to be the norm, right?
Well, again, I look a lot at the Rural Bank's annual farmland values report, and it dives deeply into regions and states, but also across the national horizon. So, that gives me a lot of faith, because you look back over 20 years. Again, you don't look short term, but you look back over 20 years, and people will say to me, there's drought and pestilence and God knows what else, and there's all these negatives around. Yeah, okay, there are places where that is, but there are other places that aren't caught up in that issue, and they're the ones that you've got to look for. And it's just like houses. There are houses in some areas that will do well, and houses in other areas that just never will.
Yeah, and that's the way this game works. Warren, for a lot of these on smartpropertyinvestment.com who are interested in fractional investing, hopefully we've covered a bit of it off. It's more really an introduction to, or 101 of. How can they find out more about you guys? What do they need to do?
Well, domacom.com.au, you'll find a lot of information there. There's a bunch of little videos that we created, half a dozen videos that sort of go through the process. They're only 60 seconds each, so they'll give you a kind of a broad overview of it. Then you can drill down into areas that might be of interest to you on the platform. There'll be some campaigns up there. Now, there won't be a lot. There's maybe, 15 or 20 campaigns that are up there. They're public campaigns. There's a lot of private campaigns that aren't viewable from our marketing site because they're private campaigns and they're by invitation only, mainly set up by financial advisors. So, we're here. There's a contact form there. If you want further information, want to have a chat to somebody, pick up the phone, send an email. We're happy to talk.
Nice one. And I'm sure you could always, if you've got a financial advisor, I'm sure you could always ask them around it as well, right?
Absolutely. And if they don't know, we're happy to go and talk to them. Financial advisors must be accredited to advise on our product. So, and this is an ASIC requirement as well. So financial advisors go through an accreditation program. With us, it's not huge. It doesn't cost them anything to do it, but it just ensures that they have a good understanding of how the product works, and then can talk to retail investors appropriately. Okay. So that's another safeguard, if you like, or for investors.
Okay. Awesome. Well, if you want more info, go and check these guys out. Domacom.com.au. That's domacom.com.au. That's Warren Gibson. No doubt he can be on the phone if you want to have a chat with him. Warren, I've really enjoyed reconnecting, mate. Once we're allowed to travel again, if you're up here or I'm down there, no doubt we'll catch up, mate, and share some war stories over the last 2 years of COVID-19.
I'll be there as soon as I can.
Nice one. Thanks for your time, mate. I hope you enjoyed that, everyone. Remember, smartpropertyinvestment.com.au. Our social media, Smart Property HQ, is where you can find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.